All right. Welcome, everybody, as people are dialing in and connecting. I see the numbers are starting to go up. There we go. I will say greetings from stormy Chapel Hill. It was a beautiful day earlier. The rain just rolled in, which I guess is a good thing to get rid of some of the blanket of pollen, as Leslie was talking about. Um, we're about a week behind South Carolina, but I know it's coming. So this is Around the World with Yusko, and the second installment on our Rhyme of the Ancient Mariner theme. Tariffs, tariffs everywhere. Is the investment environment starting to stink? So just as a reminder, a bunch of the slides I'm going to go through really, really fast. Some of them are from last time. Just as a reminder, you can have the slides and go through them at your leisure. But generally speaking, the new information has been updated in all places where I'll point out. So water everywhere, and all the boards did shrink. Water everywhere, nor any a drop to drink. From the Rhyme of the Ancient Mariner. Trade wars are good and easy to win, and tariff is the most beautiful word from the Donald. History repeatedly proven one tariff begets another, and they get a full-blown trade war. No one ever wins. Consumers get the short end, as Mark McKinnon said. The benefits of tariffs are visible, right? Union workers, get protected. The harm is invisible, spread widely. People don't have jobs, and they don't realize it. From Milton Friedman. Protectionism is a misnomer. The only people protected by tariffs, quotas, and trade restrictions are those engaged in uneconomic and wasteful activity. Free trade is the only philosophy compatible with international peace and prosperity. So these were the quotes from last time. So I say true words of wisdom. Really, all of that could be summed up in Ronald Reagan's radio address to the nation on free and fair trade from 1987. You see, at first, when somebody says, let's impose tariffs on foreign imports, it looks like they're doing the patriotic thing by protecting American products and jobs. Sometimes for a short while it works, but only for a short time. What eventually occurs is first, homegrown industries start relying on government protection in the form of high tariffs, and they stop competing. This is the key, right? They stop making innovative management and technological changes. They need to succeed in world markets. Then, while this is going on, something even worse happens. High tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. The result is more and more tariffs, higher and higher trade barriers, and less competition. So soon, because of the prices made artificially high by tariffs that subsidize inefficiency and poor management, people stop buying. Then the worst happens. Markets shrink and collapse. Businesses and industries shut down, and millions of people lose their jobs. So all in the name of protecting American jobs, do you actually destroy American jobs? So let's be very clear. A tariff is a tax. It's paid by the people importing. Most misunderstand what that is and what it does. There are winners and losers, mostly losers. Look, domestic industries that are uncompetitive, as Ronnie said, the workers, and government tax revenue can increase by a small amount, but that pales in comparison to the losers. Now, tariffs were popular in the 1800s, and people like Grover Cleveland and McKinley, ran on these policies. Now, on the far right, Trump fancies himself William McKinley, and this is a cartoon from 1894, right, more than 100 years ago, showing the American president dressed up like a shogun, rebelling basically not the infidels, but the invaders, the Chinese. And so this is not new. And this concept that tariffs are somehow going to work. Look, we have 200 years of data, and they don't work. And look, Hoover in the early 1900s said, well, I forget, am I for or against this tariff? So a little bit of waffling, but then he became infamous for supporting the Hawley-Smoot Tariff Act, maybe the dumbest piece of policy in U.S. history, maybe. I mean, it's up there. Look, tariffs were declining on the left until Smoot-Hawley. That led to trade wars, global trade collapsed, markets swooned. We had the Great Depression. And we're not saying that that's going to happen, but it is one potential outcome if you take this too far. Now look, tariffs had basically disappeared for 100 years. They're basically gone until Trump 45 turned himself into tariff man. And his 18 self, Trump 45, basically had this fantasy that somehow he would reshore American jobs. I remember when he was running, he came down to North Carolina and he was pointing his finger at this woman in the crowd saying, I'm going to get your job back. No, you're not. Her job's never coming back. She worked in a textile mill. That job went to China. It's never coming back. Now, you can get her another job. You can retrain her. You can do, but you're never getting that job back. And this idea that China was going to have less of a trade surplus was a fantasy. And the data says, yeah, it didn't work. So the problem is the U.S. exports more dollars than we invest abroad. Therefore, we have to buy more goods. So no amount of tariff is going to fix the lower left red bar. There is no way in the lower right that we're going to, regardless of who's in power, red or blue, it just doesn't matter. Tariffs are not going to fix the structural problem that we export dollars. And that's what we like to do. And look, tariffs eventually turn into trade wars. Trade wars destroy jobs, lower right-hand corner. Look, the Treasury Secretary said the third point, right? Yes, we can get revenue. He said substantial. And look, Scott's a smart guy. But kinda. I mean, yes, it's measured in billions, but when you're talking about deficits of trillions, it's just not enough to move the needle. The problem is labor productivity and incomes decline. And these are inextricable. There's facts. There's no data anywhere that says you're going to have an exception to this. And so this idea that we're going to invoke tariffs on our largest trading partners and somehow that's going to be good for American incomes, again, it's fantasy. So most people, logically, were against tariffs in 2018. We hadn't had tariffs for 100 years. And now, curiously, about half the people are supportive. Part of it is the propaganda that's saying that the global economy is unfair. It's not a fair trade. And look, the data says that the Asian tariffs on U.S. are higher than our tariffs on them. And that's just because of the way the trade flows work. We're taking more from them than we're sending to them. So, but the idea that the plan on the left is going to fix the problem on the right, again, goes back to the illogical conclusion from the basic nature of our policy, which is we like importing cheap goods to keep our quality of life high. So the Western press misses the point. It says that, this is going to hit China where it hurts. Well, 25 years ago, maybe, and that's a big maybe that would have been true when we were a primary trading partner of China. Today, we're 8%. So yes, we import a lot of stuff. I mean, trillions of dollars, but it just isn't the mass majority. They have, through the Belt and Road Initiative and through their initiatives with South America and Africa, they basically have created or recreated the Silk Road. So China dominates export markets globally. They toppled the EU. I mean, Germany and Japan, that used to be the superpowers in trade. I mean, if you go back to 1990, China wasn't really on the map. I mean, that's an amazing stat. And it's basically been over the last 25 years that they have become a manufacturing superpower. Now, Tariff Man is back, 47, Trump 47. And he wants 1930s style tariffs. We would go all the way up to 17%. But again, no amount of tariffs is going to fix the trade balance. So this tariff plan is focused really on U.S.-China trade imbalances. Ultimately, it's in the press it's about Mexico and Canada, but that's also a backdoor slap on China. Steel and aluminum, yes, it targets China, but it really hits Mexico and Canada. And steel is a good example of how China has changed their nature of financial capitalism and industrial socialism, in that they have modernized all of their property, plant, and equipment. They have built, lots of things like high-speed rail and bridges and invested in infrastructure. And one of the big things that a commentator was talking about was, when your economy for the better part of 3 decades has been driven primarily by government spending, primarily on defense, when you drop a bomb in the desert, that's it. Yes, it increased GDP, but temporarily. When you build bridges and roads, I can't talk, in China, and you increase commerce and increase development, those are long-term investments, very different. The current account surplus and weak renminbi provide a huge trade advantage for China, which is exactly what they want. The Mexico and Canada tariffs were delayed, at least for a few more days. We'll see what happens. U.S. profits follow exports. So globalization will mean lower profits, which is bad for stocks, which is why they seem to go down most days. So the early economic data doesn't help Trump's case for tariffs. Inflation expectations are rising, despite the fact that he and everybody else claims they don't. Now, I will say, Chairman Powell yesterday said the Trump tariffs are impacting inflation. No, they're not. They haven't even gone into effect yet. That was Jay Powell, I guess, assuming people don't listen to what he actually says, because that's silly. So 2 days ago, Trump doubled down or tripled down or quadrupled down on tariff rhetoric. He basically said trillions now with a T, and threatened a full global trade war. So let's go back to the surprises. The number one thing that people were worried about was a full global trade war. So one of the things that we talked about was, would the Fed have to do something to deal with a recession? Would they have to cut rates? Would they have to flood the market with liquidity? And the global central banks are cutting rates this year as if a recession was already here. And it is in some places in Europe. Consensus, on the other hand, was that GDP was going to be fine because spending was going to be fine. Now with Doge, maybe spending isn't going to be fine, and maybe that's going to turn. The bond markets have basically been telling Jay Powell he chose the wrong button. So it's kind of hard to see on the left-hand side. There's the green arrow on the right-hand side of the left-hand side, and the red arrow. So yes, he cut rates, the red arrow, short rates, the little red line, but the blue lines all went up. So the 10-year and the 30-year, they're going the wrong way. And they're basically telling him that he's making a policy error like the 1970s, and we're going to get a double pump in inflation. Now, I don't think that's going to happen because that was double counting, but market participants believe it. So on the left-hand side, inflation expectations have ticked up all the way back to 6%. That's kind of crazy. I don't see that happening at all. And business owners are saying prices are going to rise also around 5 or 6%. Which, again, that might be closer, because services costs are rising. U.S. CPI came in soft at 2.8, modestly, and Trueflation says we're actually heading towards deflation, not inflation. So this is some cover for the Fed not lowering rates yesterday. Now, the Fed math, it ain't mathin'. And the Fed is basically saying we're going to have stubbornly high inflation above target, and we're somehow going to get close to 2% GDP growth this year with the Fed fund rates staying where they are. Well, the right-hand side says baloney. How are you going to get 1.7% GDP growth for the year if you start the year with minus 1.8? You'd have to grow at 3% plus. Ain't no way that's happening. No way. So suddenly everyone is talking about a recession, and the equity markets are actually starting to price in a recession. Well, the betting markets were saying, hey, we're almost up to 50% chance of recession. But then about a week ago, those probabilities absolutely, you can barely see it, it's faint red line on the right-hand side. Those probabilities just crashed because the Fed said, hey, don't worry about it. We're not going to have a recession. All is well. The economy's strong. We're going to grow 1.8% for the year. No, we're not. I mean, we're just not. And so the question is, how are we going to grow if consumers are totally tapped out? Their delinquencies on their credit cards are almost back to global financial crisis. Retail sales adjusted for inflation, right? Which part of the problem with retail sales is the number, the headline number they report is not adjusted for inflation. So if gasoline prices go up and you spend more on gas, they call that an increase in retail sales. Well, you bought the same amount of gas, it just costs more. And people are not going out to eat. I mean, it is that, again, we haven't seen this type of retrenchment since lockdowns. So I'm not sure how you get growth. Job cuts are spiking. And the only time we've had job cuts this high, we've been in recession. And you know how that's how it works, right? They'll call the recession after the fact. And job expectations are now at levels on the right-hand side that we haven't seen since the global financial crisis. So not only are people actually getting pink slips, but people are afraid they're going to get a pink slip at levels they haven't been afraid in a very long time. Now, on the bright side, if we have a recession, they're, nasty, brutish, and short. On average, they're not that severe outside the global financial crisis and the dot-com bubble. Most recessions don't cause a lot of pain, and within a year, you're back to, or within 6 months, you're back to positive in the market. So maybe the markets are anticipating that they're going to call a recession, and we're already halfway through the correction. That's possible. Now, interestingly, this feels a lot like 2001. So in 2001, first quarter GDP was negative, big surprise. Second quarter rallied back to positive. It's on the left-hand side in the red box. Third quarter, because of 9/11, we had a negative shock, and then we rallied back for fourth quarter. So the whole year, we actually grew about 1%. It was still a recession. And you can see the markets kind of fell through March. Ides of March, maybe the end of March, they turned, and on April Fool's started back up. We got all the way back to even before reality kind of kicked in, and then the wheels fell off on 9/11. But it was a temporary blip, and if you remember, there was big stimulus added right after 9/11, thinking that everything was going to be great, and we rallied back from down 20 to only down 13 for the year, but it was 2022, which was a really crappy year, technical term, down 22. So it feels a lot like 2001. All right, printer is coming. Challenges are not only inevitable, but I mean, not only likely, they're inevitable. Look, we are in the great bear market for bonds. We're in the 6th year. And because of that, interest expense is now creeping up on a very uncomfortable level of the budget, which is one of the talking point theories out there, is that Trump is intentionally crashing the market to force Powell to cut interest rates so they can refinance the debt? It's certainly possible. I mean, he can talk the market down through tariffs and then never implement them. So it's certainly possible. That causes a lot of pain, and a lot of people are going to lose their job, and a lot of people are going to, I mean, literally bad stuff's going to happen. So I don't know that that's the best idea, but we can't refinance the debt at the current levels. And the problem is Ms. Yellen messed everything up by not locking in 100-year bonds at zero when she could have. So the Fed shapeshifted to Dove, said, I can fix it. I'll cut rates. He cut rates 100 basis points, and rates went the other way. And so the long bond basically had a really cruddy end of last year. And as you would expect, everybody sold. However, we talked about this last time, it completed a perfect DeMarc 13 count, and it nailed it to the day. And long bonds have been going up ever since. And in fact, year to date, long bonds are up smartly. And this is crazy on the right-hand side. Call options. Think about this. People are speculating with leverage on long bonds, which have high vol because of the duration. And people are buying 24-hour call options at levels that used to be reserved for things like Tesla. I mean, this is crazy gambling. I mean, crazy gambling. But that's what we've become, casino markets. So Jay Powell shapeshifted back to Dove yesterday. He basically said 2 cuts this year, and M2 is growing again. Well, why does that matter? Well, the Fed balance sheet is 100%. Now, usually markets don't get to 100% certainty, but the betting markets are basically saying QT is over, printer is coming, the Fed balance sheet is not going to decline anymore. In fact, it's going to turn around and go the other way. All right, the bear and the maiden fair. Surprise would be the bear markets take some ivermectin, have full recovery, U.S. equity markets head down. Ooh. Okay, so look, the economist asked, why would anybody bother with anything other than U.S. equities? We had the best 2-year period in equities in history. That's pretty crazy when you think about that. No one had any protection on because the market never went down. And for 2 years, it really didn't. Now, right before the market started going down, portfolio managers actually were levered long, and no one bought protection. So what you might expect would happen when no one wants protection, it's a pretty strong indicator that you probably should have bought some. And we went from basically dead money for 3 months to a pretty bad correction. Now, I love this. Institutions went from levered long to net short in the biggest reversal in history. I mean, we have never seen the red bar on the right-hand side ever. I mean, and that's partly just the speed of markets these days and how everything's controlled by automation. But that's an amazing rotation by what is supposed to be smart money. And they sold after the cow was out of the barn. So that's weird. Now, portfolio managers sell fast. And now they're at their lowest net long position since 2020. So I don't know. I mean, maybe they think, look, about half the time corrections turn into bear markets, meaning you're down 10%, you end up down 20%. So maybe they know something. Smart money selling. So what is retail money doing? Oh, they're out lapping it up. They are buying with both hands. The buy the dip mentality is strong. I mean, it's amazing. So look, tariffs create uncertainty. Economic policy uncertainty hit a new all-time high, like crazier than in 2020. Remember how uncertain we were in 2020? This is worse. And news articles talking about uncertainty are second only to COVID. Is that a buy signal? Now look, hedging decisions, when the VIX is super high, right? When it's above 33, it means that something already happened, past tense. When it's, between 23 and 33, where it was a week ago, or 2 weeks ago, I'm sorry, it means something bad is happening. When it's 17 to 23, okay, where it was for most of February, it's like something bad might happen. When it's 14 to 17, where it was in basically all of January, basically it says nothing bad's ever going to happen. And that's where it's been most of the time in this chart. When it gets down below 12, yes, something bad's going to happen. Now, it hadn't been below 12 in this whole period, but we did get to a level where people thought nothing bad would ever happen, and that's usually when something actually does happen. So VIX spikes are a strong indicator that the risk-off event has, past tense, occurred. So, when we were together in January talking about maybe buying protection, okay. And we were together in February talking about maybe buy some protection, okay. But now, I don't know. I think it's probably time to start thinking about the other side. All right. The laws of gods and men. Everybody loves the Mag 7, but this year it could stand for must acknowledge gravity. I didn't realize how right would be, how fast. So in 2024, all you want to own were the Mag 7 or the top 10, up 47%. We'd never been more concentrated in markets ever. Everyone was overconfident. Everyone thought AI was going to, take us to the moon, just like .com. I told you, it feels just like 2001. NASDAQ was back to the 2000 peak. That's crazy. And the Mag 7 were actually bigger than individual countries. So what you would expect would happen, Mag 7 morphed into Lag 7. They are acknowledging gravity, shed 3.3 trillion. Let's let that number hang there for a second. 3.3 trillion in a couple weeks. All of the Mag 7, upper right, are down. And we had the largest single day loss, almost $1 trillion in a single day. As I'm exaggerating, 863 billion. That's a lot in a single day. That was DeepSeek day. So the Mag 7 downside volatility, not unprecedented. In 2018, the first time Trump tried to strong arm Jay Powell and Jay Powell raised rates, we had the Mag 7 get whacked. And then in 2022, when FTX blew up and liquidity dried up, we had some volatility. But this one is good. The 2022 crash was deep and long. This one is deep. We'll find out how long it's going to be. Mag 7 valuations are at 2-year lows. I love when people put these charts up. Yes, but that's because the data in the last 2 years is polluted. In fact, the data in the last 7 years is polluted. We have this weird belief because of zero interest rates that, trading at 30 times earnings is normal. Okay. Or the S&P trading at 20 times earnings is normal. It's just not. The S&P should trade 11, 12 times. And the Mag 7, maybe it deserves some premium for faster growth, although we'll argue that the growth is lagging. And it's still very highly valued relative to the S&P. Now, the concentrated market risk, basically NASDAQ had no return other than the Mag 7. And now Mag 7 or Lag 7 or Gravity 7 is pulling everything down to earth. So smart money is selling as the tariff pressures mount, but the retail money, they love Mag 7. They are piling in. They are buying the frickin' dip. So on the positive side, well, positive and negative. So one person's revenue is someone else's expense. So I don't really understand why the Mag 7 publish this number and tell everyone how much money they're going to spend on CapEx and AI servers. because that's an expense, which means you're going to limit your cash flow, which means your earnings potentially are going to go down in the short term. But they're spending a lot of money, which does mean that Nvidia, based on PE to growth, so if you look at Apple, they're just not growing, and I don't know why anybody buys them at 28 times earnings with 5% growth. But Nvidia on a PE to growth ratio is actually reasonably attractive. So the problem with Nvidia is it was priced for perfection. And if they even had a little glitch, then things were going to happen. So they had the DeepSeek glitch, they had the glitch with delays on Blackwell, and if you're below the 200-day, not a lot of good things happen below the 200-day moving average. So I'm not saying NVIDIA's done here, but remember, Microsoft and Cisco were darlings in 2000. It took 15 and 20 years respectively to get back to even. I'm not saying it will happen here, but it could. So did Tesla have their equivalent of the DeepSeek moment with BYD? BYD on the right, Tesla on the left. Tesla has given up all of their gains from the past year and the Doge mania, and BYD just goes up and up and up. And if you've seen a BYD car or what they're doing with battery technology, with 5-minute battery charges, I mean, they are eating Tesla's lunch. Palantir is at the return to normal, right? The stock crashed as we thought it likely would, and went down a lot, gave back all their gains for the year. And then suddenly it went a little bit back up. So it's this return to normal part of the bubble, and we'll see how it fares the rest of the time. So, and now his watch has ended. DXY shrivels back to banner form. It's going to be a weak dollar year. We didn't know how weak. Look, the dollar is in a negative trend for 40 plus years. And it's going to continue to be in a negative trend for 40, because it will eventually be replaced as the hegemonic world reserve currency. No one really believes that, but it will happen. And periods of extreme rallies are followed by periods of extreme downturn. Not shocking. Except Goldman says the trend is your friend. So they thought the dollar would go up this year. Now remember, Goldman research historically is really bad. Goldman prop trading, really good. So if you do the opposite of their research, which is usually how they're getting patsies for, I shouldn't say that. The dollar move, let's keep it in perspective. The dollar's been dead flat for 5 years. So yes, it's a big move down this year. And I think it could get worse before it gets better. But just like clockwork, it had gotten too strong, and it needed to give back those gains. So House of Black and White, look, Saudi needs $100 oil, but man, they are doing a bad job. So EAI said oil would stay around $70, and as usual, they're wrong. They said supply and demand would be balanced. As usual, they're wrong. Look, Trump threatened OPEC on January 25th, and he basically said, you better get oil prices down. OPEC politely declined. They called a meeting on February 5th and said, no, thank you. So Goldman said, all right, if they're not going to cut, then oil prices are going to go down. So guess what happened? Oil prices have collapsed. And you throw on top of this fears of global slowdown, excess demand, and you have a cocktail for very, very bad oil prices. So energy stocks, though, wildly out of favor. Usually that's a good time to buy them. We just made a ridiculously interesting double bottom, super oversold, and have bounced sharply. Despite oil prices making new lows, oil stocks and oil service stocks have bounced when everything else is getting crushed. Now, is that just capital rotation, people buying what's cheap? Yeah, maybe. And we still love AMLP. I mean, MLPs are cash machines, literally. They don't care about the price of oil. They just transfer hydrocarbons and charge a toll. And they are gushing, pun intended, free cash flow. The red woman, crafty Christine, is going to save European stocks because the European market, European economy is a mess, but people don't buy stocks based on economics. They buy stocks based on things like interest rates. So look, Germany found out that trade wars are not easy to win, and they went into recession. In fact, Germany's decline in economic power has been nothing short of epic. I mean, their fall from grace and to go to basically 2+ years of stagnation and working on a third is stunning. I mean, it's stunning. Now, Ms. Lagarde cranked the money printer back to maximum burr, but is it too little too late? Well, no. I mean, they got a stronger euro, but remember, a stronger euro is bad for exporters, so that's why Germany doesn't really love Christine very much. So she needs them to cut rates. Now, stock market, wow. I mean, we didn't think it would go up this much, but it's been a rocket ship in a world of every place else going down. European stocks keep making new highs. DAX made a new high the other day. Even the companies that are getting their butts kicked, like BMW, Porsche, and VW. I mean, VW is having to shut down plants and sell them to China. Even their stocks are going up. So, and the one that's just been my fave is the European banks. I mean, the European banks, Ms. Lagarde, basically, remember, she's an ex-banker. She's helping them hand over fist. Now, they're a little overbought, so I'm a little nervous, but this has been a great trade, and I think we'll continue to pay dividends. I would still be long Deutsche Bank, short JP Morgan if you like pair trade, but this is crazy. I mean, the U.S. has outperformed Europe basically for 2.5 decades, for the entire first quarter of the century. And basically, we reached a level where you just couldn't get any worse. And so in just a move that is really unprecedented, except back in 2000 during the crash, which again, it's feeling a lot like 2021, 2001, we saw CTAs basically go short U.S. equities and long 52 billion of equities, the second biggest, the largest spread that we've ever seen. So investors are piling in to European stocks at rates we just have never seen. So we said that the problem for Japan was they got this new head of the central bank, and he thinks that academics win over real world, and that he can just raise rates and everything will be fine. And look, they've been economically stagnant, even worse than Europe, for a long time. So I guess his theory is, strong rates are a sign of economic strength, low rates are a sign of economic weakness. So we need, higher rates. Okay, there actually is some logic to that. But the problem is leading economic indicators are going the wrong way. So raising rates was not going to help that, but he did it anyway. And the bond market has exploded, and we've seen a massive unwind of the yen carry trade. And look, Ueda, he burned all the hair off with the super brain. But he is basically saying inflation's coming back, high interest rates are coming back. The question is that a good thing? Corporate profit growth would say no, although they're starting to upgrade, so maybe it'll turn out. But look, he has strengthened the yen from 160 to 148, and he's trashed stocks. So the land of sinking stocks was not too far off. So Dragon and the Wolf, surprise is that the Trump tariffs don't dump Chinese stocks. Shanghai flies. Look, Chinese equities gave back all of their alpha from the 2000s. Even though they had better earnings, no one cared, and they bought U.S. stocks with much lower earnings growth. No one was talking about Chinese stocks being better than U.S. last year, and therefore, and they were selling them, right? China started the first 2 weeks of this year down, the worst they had ever had. Media saying it's just a matter of time. Uh, Now, if you look deeper, there was a thesis that I think is playing out that said China, as they always do, had a plan. They are the largest holder of U.S. debt, or second largest holder of U.S. debt. And they basically said, you know what? Sold to you. We're going to sell our treasuries and we're going to force your hand because you can't afford higher interest rates. If we don't buy your bonds, interest rates will rise. You have a massive debt that continues to rise because you can't control your spending, and therefore we end up with all the leverage. And this is the best part: lower interest rates mean the PBOC has more liquidity to directly inject into the economy through lending. You can get a loan in China today in 60 seconds, literally 60-second approvals. The PBOC has lots of capacity because of how weak the renminbi has been. So they are in this perfect place. And so maybe they're the ones laughing. And on the far right, I updated China trade surplus came in at the highest level ever in February. Now, maybe that was front loading because people are afraid of tariffs. I think he's going to back down on the China tariffs personally, but we'll see how that plays. Everyone thinks China is going to lose the most. No, they're going to lose the least. Everyone loses in a trade war. Mexico loses the most, but then the United States comes in second, and we are vying for the title of biggest loser. And our trade imbalance is literally off the chart. So this idea that magically we were going to fix trade with tariffs, it's never been a good idea. It's never going to work. It ain't going to work this time. And I don't really know who is counseling Trump that this is a good idea. I don't. So Chinese equities bounced sharply. They are one of the best performing markets this year, and still super, super cheap. Not the cheapest. Brazil is the cheapest. A shares, less bouncy because of state-owned enterprises that, are the big uglies that, but on a relative basis, valuations are nearing extremes. Tech stocks, look, not only are they growing faster and performing better, but they're selling at cheaper prices than U.S. tech stocks. So you don't have to abandon tech. You can own the same types of companies as Google and Amazon. You just can own the Chinese versions and we think do better. Xi acknowledged that tech was back. He took Jack Ma out of cold storage. Another casualty of trade wars, interestingly, is U.S. retail. And this is the Temu effect. When things get bad and you're maxed out on your credit cards and your income's falling and inflation's rising and you get laid off from your job, you're not going to go shopping at, Target or Walmart or the dollar store. You're actually going to buy stuff from Temu. And this is crazy because remember 2 years ago, not 2 years ago, a year and a half ago, Super Bowl, Temu had these massive ads for Super Bowl. And everybody's like, why are they airing? Well, that was why. Because they saw this coming. And they probably saw it coming through all the data they collect with TikTok. But the Terrific 10 is crushing the Mag 7, and yet no one cares. I mean, the exposure to Chinese tech stocks is tiny, except for this guy. Most of his portfolio is Chinese tech stocks. And when asked on TV, well, what about tariffs? He says, my hedge is, I don't care about tariffs. It doesn't matter. The China rally hasn't really begun. So it's up a lot this year, right? 30+%. But it hadn't even started because global equity funds have 14 times more exposure to the U.S. than China. 14 times. Now, it was 9 times, and now it's 14 times. And so I'm not saying it's going to get back to parity, But that 14 is I think going to be the peak, and we're going to head back toward maybe 10 or maybe even 5. So I think this is just getting started. Chinese stocks off to their best start ever. Actually, the best first 3 months in Chinese history, which blew me away. Yet we got a long way to go. I mean, as great as this year has been, KWEB is still down a ton from their peak in 2021 when the Biden plan went into effect. So breaker of chains, surprise this year is that the cycle is still with us. Bitcoin will rally all the way to 150 or more and then fall hard in the second half. Look, long term, let's keep the long term. Bitcoin is technology. It is technology for money. It is a better form of money. This is the new internet, and it's the internet of value. And so this is following the same innovation cycle, and we're in 1999, early 2000. 83% of institutions surveyed said they were going to increase exposure. That's a lot. Now, investors, of course, chased the hot dot in Q1. Now, if you look on the right-hand side, this is pretty amazing. It said that, we'd have a correction kind of in Q1, that we'd head down like 72K, and then we would rally all the way to 150 by September. That was consensus. Now, right on schedule, we had our pre-tax day correction every year in March, particularly in a year where the previous year was a big up year. People sell to pay their taxes. So that's what happened. And then the Ides of March occur and you get a rally. And so we didn't get all the way down to 72. And despite the pullback, Bitcoin is actually, other than volatility, the best performing asset class. It is the best performing and volatility second, but it's outperformed everything else, despite the fact that it's pulled back for a while. Fear and greed is neutral. That's up a lot from the extreme fear we were in maybe 6 weeks ago, but overall sentiment is near all-time lows. It's not as low as during lockdowns, but it's pretty darn low. And we're at a level roughly the same. On the left-hand side of that chart on the right, you can see that double top back in 2021. So remember in 2021, in February, we made a high in the 60s, and then Elon tweeted, we went 50% down. We didn't trough until July 15th, and then we rallied for the rest of the year and peaked in November before the bear market started. So panic selling. We had 5 weeks of outflows. Now, part of that wasn't panic selling. That was unwinding of the futures trade, which we talked about last time. And what I love is that the people who were selling, the retail panic sellers, they were selling to the diamond-handed whales. So the whales have been buying at the highest level in years. Well, why would they be buying? Why wouldn't they be distributing to the masses? That's what insider sellers are doing at big companies. Why would the whales be accumulating? Well, they probably think it's going up. So active Bitcoin address activity has been a very good buy signal. It just flashed a massive buy signal this week. And on the right-hand side, we kind of had the shakeout. That chart says 150 is the peak. I think it's just coincidental that all these numbers kind of come out to the same place. Bitcoin treasury strategy, even over 1 year, despite the correction in MicroStrategy, it still beat everything else. It beat gold, it beat NVIDIA, it beat Tesla, it beat everything. So now there are 80 companies that have adopted the Bitcoin treasury strategy, and the little company I'm involved with, MetaPlanet, which I'm headed to their annual meeting next Monday, is up to number 10, which is kind of cool. They're the 10th largest holder of Bitcoin on the balance sheet in the world from zero a year ago. So Bitcoin is highly correlated to M2 money supply. Now, it's a lag. Now, is the lag 90 days, 60 days? This guy did a lot of work on correlation and said it's 107 days. And so he's basically saying that April 30th, we have blast off. Yeah, that's possible. And, I think maybe it's summertime. Probably isn't July. It's probably June. So sometime between, May 1st and June 30th, sometime in that range. Now, this is an interesting chart. So there's been a lot of discussion this week about this crypto whale on the right-hand side who was they call him the short whale. And he had basically made a 40 times levered short play, got as high as 500 million bucks at one point. He just flipped. I mean, he literally flipped his position yesterday from short to long. And now there are 6 billion of open short interest at 90K. Liquidations would happen really, really fast. And that 6 billion is bigger than the 4.5 billion that came out in the ETF liquidations. And that trashed prices from 106 to 79. So how fast could prices go up? They could go up pretty fast. I'm not saying that's going to happen, but it's interesting when someone covers a short and reverses a position. It's maybe the hardest thing to do in trading is to change your mind and then change your position. Pretty good. All right, bonus surprise. Gold wears the crown and prices go to 3,000. Oh my gosh. So look, we entered the boom period of the economic super cycle, which meant you favor commodities. Dr. Copper was not buying it in January, but man, did it break out in a hurry. It is not worried about trade wars. It is basically saying China is stimulating and we love it. So gold glitters after a rapid dollar rise and a decline. We just had a picture perfect rapid decline, rapid rise and decline. Lots of stuff here on why gold's setting itself up for a big bull market. Central banks were buying gold as if they knew something. So Goldman raised their price forecast to 3,500. Look, gold was poised to make a significant move. It blew right through our $3,000 target in 3 months. So I guess we got to change our target. Gold market cap surged $5 trillion to 21 trillion. And the monetary value of that is half. So call it, 10.5 trillion. And Bitcoin's only a little more than 10% of that. So if we think Bitcoin's going to Bitcoin gold equivalents, that's a 10x from here. So, all right, fine. Gold crushed stocks over the past year, left-hand side. And it's not close. I mean, 40% to down 5. But 25 years, stocks crushed gold. Nope. I mean, it's crazy. 2x return from gold versus stocks. S&P for 25 years, 7.2, well below the long-term average of 9.5. And that's because of the period at the beginning of that in 2000 to 2002. And I said, it feels a lot like 2001. And gold did really, really well then. So the bottom line, to summarize the In Gold We Trust report, you don't own enough gold. And this is a great report. I mean, it's super in-depth. Like I said, 18,000 hours of research, 400 pages. It's a great read every year. But if you don't want to read it, you just don't own enough gold. The problem is investors have abandoned gold and gold miners. I mean, allocations are sub 2% in gold and, sub 0.5%, like 0.25%. I mean, there are no natural buyers. Now, a little bit on the right-hand side, a little bit of signs of life in gold ETFs, but gold miners are minting money. At $3,000 gold, they have massive margins. And yet, the gold miner gold ratio is at levels we haven't seen very often in history. So investors rediscovered gold miners in January, and they went up a lot. relative to equities. Okay. But they could rocket higher. And look, gold miners, as much as they've gone up in the last 2.5 months, they've formed, I mean, they don't get much more picture perfect than this. It's called cup and handle pattern. These could go really high, really fast. All right. If you want to hear the last time we talked about this, you can go to Around the World and all the other ones we've done before. Hedged. Corey just did a great overview of the year in review. Take a listen to that. And then digital currents every week. We get out there and X and I get out there, and I did this one solo because X was on paternity leave, welcoming baby number 2. Excited for him and the family. And then I'm still chilling these books. If you haven't read them, you should read them. And that is that. And with that, I will finish right on time and thank everybody and have a good March Madness. I hope your team wins your bracket and have a good one. Thanks, y'all.